Welcome back to the YouTube channel. Thanks for all the support in my last video. And I hope I fixed audio. If not, let me know what you think. And let's jump into this video. Today's video is going to be about why I think that not every home buyer is making the right move or a smart decision. And why I think home prices in California and Florida are going to go down. And I got data to back it up. So follow to the end and let me know if you disagree or agree. So in the last 48 hours, Allstate came out and told California that we are no longer insuring or underwriting new homeowner policies. What does that mean? That means that all these people that had Allstate in California do now have problems renewing or getting new insurance. So that is really, really bad news for people that are trying to buy a house, want to sell their house, or just homeowners in general. And you might say, well, why is that a problem? Well, if insurance company cannot insure houses for most people that do not have the liquid cash to buy a house and need a mortgage, and I would say that's probably 95% of all people. That number I just made up, but I think it's probably 95% of people buy their house with a mortgage, and a few percentage of people don't. So why does that matter? Well, in order for a bank loan to approve, you need to submit all your documents. And I've bought a few houses, I own a few rental properties and a primary residence. I'm on my second primary residence that I've owned now. And it's really, really interesting to see how stuff changes over the time. So when you buy a single family residence, they'll pull your credit. And when you pull your credit and they show you financials, your purchase amount is based off of your income. Kind of makes sense, right? So when you go out and you buy a house and you want to buy a $500,000 house, you need a certain amount of income to support that mortgage. Well, now we're having a problem that homeowners insurance in California and Florida is going up like crazy. That does not affect cash buyers. So if you're a cash buyer, you can just do whatever you want because you probably have the money to pay out big time if there's a problem. So I looked at the Florida stats right here for homeowners insurance, and it's $2,700 on average, but that is for a $250,000 dwelling cost. So that means the replacement cost of your house is going to be $250,000. Well, with inflation and where we at today, I do not think that $250,000 will replace your house. And so that $1,300 is nothing, right? Because if you can't replace your house and you can only afford to put a roof over it, but no electrical wires, it's probably not livable. So what you got to do, you got to increase that dwelling price by a lot, by probably double. And now we're already at almost $3,000 something. And that doesn't cover flood insurance or something else. And so what does that do with the housing market? Well, when there's cost associated with buying a place that isn't foreseen, mortgage brokers will know that, because the last thing a mortgage or a lender wants to happen is you defaulting on your mortgage and they're not making money and have to take it in the pants because you were responsible and thought, I need to buy a house, and actually you couldn't afford to buy a house. So now when you are, wow, the wind's going. Let me know if you hear that. Mental note to myself. So when you are trying to replace your house with another one and you can't afford to do that, and that is now calculated into your price, what does that do? Well, that's going to decrease your buying power. And what does that do to home sellers? Well, home sellers now do not have the power to ask for top dollars, because you want to sell because you want to get rid of it or you want to move. And when stuff is increasing by a certain amount, like by a lot, and I've watched this other lady on TikTok that underwrites insurance policies, and she said one of these houses in Beverly Hills, California that she's insured for many years, went from $4,000 a year to $40,000 a year because of the fires. So now, this is really windy, honey. We got to walk down there. So when you're talking about $40,000 in premium insurance for fire insurance and all that other good stuff, that's going to be tacked on to the new homeowner that's going to buy your place at one time. So you might don't care because you might going to say, I'm gonna leave this house to my kids. Well, your kids are probably going to have to sell it because they cannot afford $40,000 in homeowners insurance or in fire insurance. And most people will then have problems saying or doing, putting it on the market and doing, the ads and all that, and getting it on the MLS and doing all that crazy stuff, because when you're going to get rid of when you try to get rid of the place and you're like, I'm done with it, and somebody's going to come and buy it, they're going to run comps, insurance, and everything on the place. And it's going to be great when he's going to see that's $40,000 a year is going to go towards fire insurance. So you got to make pretty good money in order for that house to go for a lot of money. So what happens in the real world when somebody has $40,000 worth of extra expenses besides mortgage? Well, that's going to decrease your monthly mortgage allowance. What does that mean? Well, that means you can now borrow $40,000 less a year, basically, so to speak, towards your mortgage. So when you calculate out $40,000 divided by 12, that is an additional cost to you. So what is that exactly? Well, let's get the calculator out and find out right now how much you're going to have to just pay in fire insurance in California. So you'd have to pay $3,333 in just fire insurance for that one woman that had it. So now let's look at what else is going to go on. So you need somebody that's going to have $3,300 to pay for fire insurance. Then you need them to still cover your $1 million mortgage or whatever it is, and that's going to be another $6,000, $7,000 depending on interest rate. So now you're at $10,000 and you haven't even bought anything else yet. Yes, if you're financially super rich, you can do it. But if you're most Americans, you probably cannot afford it. And the thing is, with all these mortgages and these insurances going up and mortgage rates going up, is it can't keep going up. Everybody's saying, oh, it will go up forever. High interest rate hasn't affected us yet. Yes, that is simple because of supply and demand. So when there's more supply than demand, the price goes down. If there's more demand than supply, the price goes down. Oh yeah, goes up. But when you take that into consideration, when you look at the whole facts and nothing but the facts, right now there's a lot of people that, like me and Allison, bought our house for $900,000 and we have a 3% mortgage rate. So we are basically married to that house for the next 30 years. Will it go up or down? I have no idea, depending on what the Las Vegas housing market does. But it's interesting to see when new people try to buy a house that's less expensive, but their mortgage is double. So now you're in a very kind of strange thing, like Barbara from Shark Tank says, you should buy the house whenever you can. Well, I kind of disagree with that, because I read an article the other day that said renting is 25% cheaper than actually owning. And I would actually agree that renting is a lot cheaper than owning. Yes, you don't build equity, and yes, you can't do whatever you want, but that's a lifestyle. That's a lifestyle change, and that's a lifestyle that you're accustomed to. So when you're looking at renting, you can actually rent really nice places now for cheaper than you can actually buy them for. So you can rent, and I made a video about this last time, that you can rent and save the same house as you could buy for, and you could save $500-600 a month with just renting it. And you don't have to replace air conditioners and anything else. So you can then say, oh, there's rental increases. Well, there's stuff that breaks. So it's like, oh, there's the landlord can do whatever they want. Well, no, they also have to go by the laws, and if the rent gets too high, you got to move. You have money to move because you saved $600-700 each month, and you've put that away. And you can cancel the lease and be out of there after a month or so, after you stayed a year, obviously. But then it's month to month, and you can, if you're not going to sign a new year lease, then you can be out. And when you want to sell the place, you have transaction costs, right? So you got to have to spend money basically to sell the house. When you rent, you just move. So what Barbara was saying is that you should buy a house. But if you're going to buy a house in California and Florida, you're going to be in trouble. Because as I'm not seeing new wage growth happening as quickly as things are skyrocketing. And when insurance companies are pulling out of the market and they're not happy with how it's looking with Florida and California with all the wildfires, and the state has to come in and do some kind of insurance plan for it, and you got to be accepted and all kind of stipulations to it, that's going to really drive down the prices, because most people just want to buy something and live in it. But when your cost is so high and you have a budget of $5,000 to rent or to buy, you say, I have a $5,000 budget, or $3,000 or $2,000, whatever, and half of that is taken up by insurance. What's that going to do? That's going to cut your price per, your house price in half that you can afford. And you might say, well, Rico, people have the money and the economy's doing great. Well, but you can't everything go up on the middle class, and I'm not talking about the upper class, like the top 5%. Those people will be more than fine. But everybody else, it's going to really, really struggle if these homeowner insurance, fire insurance, flood insurance is going to go up like they did. So that brings me to the next point. What do you do? Well, if you live in a state like that and it increased by that much, you need to make sure that you get out. Because if you have $1 million and you have your house paid off, and insurance is going to go really sky high and you can't sell it for $1 million, but it's going to be worth 700 because you can't make up for the difference because it's so expensive to have insurance on it, you basically got played. Because when there's other factors involved that you are not in control of, you can have the nicest house on the block, but if insurance is going to go through the roof, you're going to be screwed, because there's nothing you can do about that. You can't come to a better time. You can't refinance. You can't make insurance go down without doing some sketchy things. And you can't just go, oh, I'm going to find a different bank that's going to refinance or do something. No. And that leads me to my next point, the refinances. Are you going to refinance and take money out of your primary residence to keep insurance on your house? I think that's a horrible idea when you have to take a HELOC or a line of credit or do something like that just in order for you to keep the house. So that is very, very difficult. So when you're looking at buying a house in Florida or California, like I said, those are the states that are most impacted by crazy weather, and those insurance companies are making enough profit off of Florida in order to stick around in Florida and insure these places. So when I would move to Florida, because I thought about it, I'm glad I didn't here in Las Vegas. Thank God that I didn't go to Florida, because I would be one of these persons that would have bought a $600,000-700,000 home, and now I would probably not be able to afford the homeowners insurance or flood insurance after this hurricane. So what I would do is I would see if you can rent cheaper, because there's always landlords, single, not like corporations, like single families that rent out homes, not big corporations, and see if you can strike a deal and see if you can find a house to rent that isn't outlandish priced, and see if you can rent there, because then he needs to carry it. And when it floods, you can say, and stop making payments. Sorry that happened to you. I'm going to make an insurance claim on my end for all my property stuff, and I'm out. I'll see ya whenever, but I ain't coming back. So I know that's harsh because people are like, I got family there. But it doesn't really matter when you're just living there and you can't afford it and you can't make payments, because everything went sky high.